In this session, I'll be talking about the credit scoring and the retail credit risk management. So here the focus is completely on the retail credit risk, individual loans, right? Not the company specific, not the corporate loans, and how the credit scoring can really play an important role in managing the retail credit risk. So the focus of this session would be primarily on retail banking, giving you an introduction to the world of credit scoring, why it is required, how it is done, and the dark side of how to manage the retail risk. What are the kind of flaws that are existing with respect to managing the retail risk? And how can you really overcome those kind of flaws? How does the credit scoring really play an important role in performing the credit risk management? And we will also talk about the other risks apart from the credit risk with respect to the retail banking. And we'll see what are the different kinds of scores that are typically computed. And for computing different kinds of credit scores, what are the kinds of information that are typically collected? And how does this credit score help me in terms of identifying what would be the default rate, probability of default, and loss if a default is typically occurred? How can the score, credit score that is computed, help me determine these kind of processes? And how do I really measure what kind of a scoring model is much appropriate? How do I measure the performance of a particular scorecard? And how does it help me to determine the customer value? How do I really get into looking at the customer relationship cycle? And finally, what do I really mean by risk-based pricing mechanism? So this is the content of this session. So getting in, I think this is the part something all of you are quite comfortable with. Retail banking, more and more associated with individual level banking. So individual consumers and very small businesses. That is what goes as a part of the retail banking, where the characteristics are not unique, but the characteristics of the customers who are involved in this retail banking is more homogeneous compared to that of a corporate banking. So the major business is deposits, saving deposits, loans, fixed deposits, time deposits. It's more of different kinds of deposits and loans, lending business. That is what typically goes in the retail banking operation. And nowadays there are lots of innovative products, even in all these things. The credit cards, lot of innovative products, lot of marketing, risk management. So today, nowadays, even this retail banking has become one of the core operations to work with. And it has been growing. And the earnings are more and more stable in the early years of the millennium. Up to the financial crisis, up to the global financial crisis, this has been growing relatively stable. But the way the subprime lending has been controlled, has been handled in the entire US mortgage market, that is what has led to the entire securitization as a process failing quite badly, and that is what is being perceived as one of the major contributors of the financial crisis, right? So this was a kind of a blood that came up typically on the retail banking as a industry, correct? Now, what are the different kinds of loan products that are existing? There could be home mortgages, so which is more like the loans given for purchasing the houses. They can be in the form of either fixed rate loan, fixed interest kind of mortgages, or adjustable rate, which is more like a floating rate. and generally you see that they are secured by the residential properties. So if I have to take a loan against my house, I keep my house as a collateral with the bank to raise the loan for it. And the loan to value ratio, this is a very key element. If the worth of the if the worth of the house is 1 million and I'm taking a loan worth 0.8 million or 800,000, then the loan to value ratio is 80%. But if I am taking a loan of 1 million, then the loan to value ratio is 100%. So it is talking about the proportion of the property's value which is financed in the form of a loan. So this is what we are calling as a loan to value ratio, which is one of the key elements which decides the riskiness of that particular loan. Then we do have home equity loans that are typically given as a part of the retail banking world. So it's a kind of a mix between the consumer loan and a mortgage loan. And it is secured by residential properties. We do have installment loans like revolving, more like credit cards, and where once you pay off, the credit limit can be used up to a specific limit, and again once you pay, the limit will be revived. That's a kind of a revolving loan, and you see that there are different kinds of revolving loans. You have credit cards. Once you use up all the credit limit, you pay back, you can very well again get the entire limit being revived. So they are more and more on a revolving basis. And for these kind of products, we see the real assets or financial assets are generally used as security. And the credit card is a kind of a revolving loan which is more unsecured. We don't see any kind of collaterals being taken for that. And the retail banking is also about small business loans where the secured by the assets of the business, the collateral typically is the assets of the business or some kind of personal guarantees that are given by the owners of the business. So this is what is a retail banking industry in a nutshell. Now, look at the exposures. What are the different kinds of exposures, or what are the typical characteristics of the exposures that a retail bank typically faces? You look at majority of the loans, they are pretty much homogeneous in nature. So low value loans compared to corporate loans. The value of each loan would be much lesser, but there will be so many number of that. So a lot of customers taking small amounts in the form of a loan. Even if you look at a business as well, the amounts are much smaller compared to big businesses which come under the corporate banking kind of a world. And one single exposure, if it is being added, one new loan taken, the incremental risk is much smaller. Even if one party, 1% defaults, the impact on the bank is much negligible. So it has to be looked at separately from a traditional corporate banking based risk, because the loan amounts are much larger, and one single default is going to impact the profitability of the bank very badly. And how do I look at the retail credit risk here? As I have already said, for each loan the amount is small. So one single customer defaulting is not a big issue for the bank. It does not threaten the existence of the bank. It does not make the bank go into default. It does not question the existence of the bank. And another important criteria is lot of these loans are independent. The default correlation between them could be much lesser. So they are not concentrated by the geographic areas. So there is no concentration by geography or industry sector or anything. So it looks more like a well diversified portfolio in a normal market. If one party defaults, it does not necessarily mean the second party will default. They are all completely independent. But of course, when the whole economy as such is down, then there is a good chance that a good number of people can default together. That's the reason we are using the word normal market. When the markets are more or less normal in nature, they behave like well diversified portfolios. The expected loss can be like much other. You can very well expect how much could be the typical loss by looking at the probability of default of a particular customer multiplied by the loss given by default. These two will give me the expected loss that I can get on a typical portfolio of credit. Then I'm talking about the relative predictability means the expected loss, whatever I'm expecting through this. So whatever is the total loan amount that is at loss, exposure at risk, multiplied by probability of default multiplied by loss given default is going to give me my expected loss. And because I can expect up to this much, this I can take it directly into the price that I am charging for the customer for that homogeneous group of customers. So there is a good chance that the lending process to the customers can happen in the retail model. I can start lending to the customers without doing a big due diligence process. But that can directly bring in a hidden systemic risk into the credit portfolio. If I don't check the credit worthiness of all the customers, there could be a kind of a systemic risk. A few customers defaulting or probably economy not doing well, probably all the customers are going to default at a time, which could cause a very huge systemic risk to the process. Now that is what we call as the dark side of retail risk management. So many innovative retail credit products that have come into the market, they don't have the historical loss data. They are very innovative products, whether it is credit cards or any other loan mechanisms, different kinds of loans that are being issued nowadays. There is no historical data. So identifying the quantum of risk that is typically built into them is very difficult. And so the way they behave under different economic scenarios, under different market conditions is completely unexpected. And how they really react to a changing economic circumstances cannot be understood because there is no sufficient historical data. That's one of the dark side of the retail risk management. So if the recession is very intense, right, continuing for quite a good number of periods, and the interest rates are much higher, now think of it. People can keep on defaulting. So the mortgage defaults are typically going to high. One, the interest rates have gone up, so the amount that they have to pay is typically going up, and there is a recession, they can't earn. So the mortgage defaults are going to increase quite drastically, and the interest rates going up, their asset values are going down. Recession, they can't earn. So both of them doubly leading to a double impact in terms of mortgage defaults typically increasing. Now, there is a different side to it. It's more relating to the attitude of the customers, whether they want to default or not. It's just not about their ability to pay, whether they really have the funds to pay or not. Even I have to look at the social system, the legal system, which deal more or less with the willingness to pay. We see lots of examples, people taking the loans and with a political backup, they typically abscond paying the loans in some of the countries. Now, what does that mean? It's more not about the ability to pay, or in some cases, the politicians typically to gain political power give a lot of freebies, and a couple of those freebies could be waiver of the loan. Now, there the problem could be with respect to the willingness to pay. They may have the ability to pay the loan, but they are not willing to pay. Now, how should this kind of things be really addressed? So, there are so many social and legal kind of aspects that need to be looked at. And any operational issue that is affecting the credit assessment of the customer, wherever I am not able to measure the credit worthiness of the customer because of some operational problems, believe me, it can really have a systematic impact on the whole portfolio. That would be one of the key contributors if the whole portfolio has. That is what we have seen in the recent crisis as well. A due diligence not properly taken in terms of giving subprime loans has been one of the major contributors in the entire global financial crisis that occurred. Semi-automated decision-making process rather than a series of tailored decisions can really impact the overall scenario. Right? And the other side, banks have to try to make sure only a limited number of their retail credit portfolios are vulnerable to new kinds of risk. They can't have 70% of the loans in terms of subprime and only 30% prime. Then they are making themselves much more vulnerable to the newer kinds of risk. So initially the piloting has to be done with a very small percentage of their customer base, and slowly on a need basis the number can very well be increased. And banks should have sophisticated models in place where they perform stress testing in depth to really assess what could be the worst case scenario. How much can be really lost if how much is the worst case loss that can occur if the economy goes completely bad, if the interest rates go completely unexpected. What could be the typical loss, the worst case loss that can very well come up. Now, all these things have to be really understood and appreciated. And once appreciated, obviously the next step lies in terms of how to deal with it. So whosoever is issuing the loans, first of all, assessing the ability of the customer to repay, the credit worthiness of the customer. Does he really have the financial ability to repay the loan that he is taking? Now this is where we are talking of whether the mortgage is qualified or not. When I am saying qualified, there are no excess upfront points and fees. There is no toxic loan feature. That is what we call. So whenever I am saying something is a qualified mortgage, in the beginning I am not charging anything from the customer. The loan does not have toxic features. What are these toxic features? Negative amortization loans. Means it's like this. Let's say you have taken a loan for 1 million, right? And you have taken it for 20 years. The interest rate, let's say, is 5%. Now, a 20-year loan, 5% or let me take it as 6%. 6% is the interest per year. So automatically the whole thing is coming out like 0.5% per month. And on this 1 million, my interest in the first month is typically coming out to 50,000. Or 5,000. 5,000 is the interest that I pay in a month. Am I fine? But let's say if the EMI that I am charging is only 4,000 per month for the first year. When the interest I have to pay is 5,000, my EMI should be at least, let's say, 6,000 or so. So that 1,000 is paid towards the principal. But if the EMI itself, I keep a different kind of a process and say for the first 2 years you pay an EMI of only 4,000 per month and the recalculation happens at the end of 2 years. Now this first 2 years is looking like a teaser, attracting me. I'm going for a loan, but at the same time, this is what I call as the scenario of negative amortization. Right? It ends up wherein I keep paying a much lesser EMI than the amount of interest I'm supposed to pay. So that negative also gets included. So I'm paying a negative principal instead of a positive principal amount. So the worth of the loan is typically increasing after 2 years, which gives me a kind of incentive to default. And sometimes having a loan having a very large period, 30 plus years, even that is what is considered as a toxic feature. And interest only loan for some period, that is what is adopted today by a few bankers for real estate kind of projects. So interest only loan for a few years and the balance would be paid, and then the principal will start keeping on paying after a couple of years. Now all these are unnecessary teasers to typically attract people towards borrowing, and they are the ones which are termed as toxic. And I really need to know how much income can go towards the debt to income ratio. What proportion? If this person is earning $100,000 a year, what is the maximum amount of loan that he should be eligible for? Should he be eligible for 5 times that, which is 500,000? Or should the maximum eligibility be 1 million? How much should be the maximum that he should be eligible for? And so I really need to have some kind of a cap on that. That is what will become my qualified mortgage. And there should not be any kind of a balloon payments. Now all these things will make a mortgage more and more qualified. Then we should also look at it from a different perspective, which is the ability to repay, wherein I have to look at all these aspects of my customers. What is his employment status currently? Is he working or is he unemployed? What is his current income? What are his current assets, credit history, monthly payment for the mortgage history, other loans he has and how much he is paying towards each of them, and any other debt obligations that he have, and what is the debt to income ratio, to what extent he is making the payment, to what extent is he earning, what proportion of the income that he is earning is he paying in the form of interest and principal contributions or EMI contribution. So all this is a very important stuff in terms of assessing the credit worthiness of the retail customer. And look at the default risk. Probably the best way to identify is a change in the customer behavior. Till yesterday, till the last month, till couple of months back, he was paying the credit card payments promptly on time. But suddenly he stops making the payment. Now, I'm not saying he's going into default, but monitor the behavior of these kind of customers. These are the pointers. So, alter the rules governing the amount of money it lends to the existing customers. Probably make it more and more based on the kind of repayments that are typically being made. Even the marketing strategies need to be altered. Right? More and more try getting less risky customers. Try to accept them much faster, quicker, less documentation, but let that be a harsh thing on high risky customers. So if you are getting across more and more high risky customers, probably you may not really reject them, but try raising the interest rates based on the likelihood of default. If their likelihood of default is much higher, let them pay very high for let pay a very high cost in the form of interest rates for that risk. Banks compete for even more business volume by lowering the standard. That's something that they should not really look at. And we have seen that that was one of the prime causes for the subprime crisis. And the other thing is, when you look at the capital requirements under Basel 2 and Basel 3, for retail loans, the requirement of the capital is much lesser compared to corporate loan. So the amount that they have to set separate for against a retail risk is much lesser compared to that of a corporate loan. So the reason being, one side is the homogeneous behavior of multiple loans. So there is a lot of predictability in terms of number of defaults, amount of default, all these kind of aspects. And at the same time, you could see that they are more and more safer because you take collaterals quite comfortably. You don't have much of a problem in assuming the collaterals. The properties that are typically being purchased are kept as collaterals, which will make the bank more and more safer. So there is a good way to identifying what is the probability of default, how much the loss typically occurs in case the default occurs, and what is the total exposure at default, which is these are all easy to determine in case of a retail banking portfolio for retail loans, and the customer segmentation and differentiation can be done quite effectively. And there is a kind of a possibility where I can compute the credit scores for different kinds of customers, and based on the credit score I can very well segment my customers, and based on that I can take my decision whether I can give loan to this particular customer or not. So the credit risk handling is one of the key aspects with respect to the retail banking. But otherwise, you see many other risks also that are typically faced by the retail banking. I could see an interest rate risk, right? So basically, it could be created on the asset side or even on the liability side. Especially when we have specific rates to borrowers and depositors, different rates to borrowers and depositors, we can see an interest rate could in some cases increase the value of the assets and decrease the value of the liabilities, or vice versa. And here it is completely transferred from the retail business line to the treasury. So it has to be really handled through the asset liability management of the bank. The liquidity risk management department of the bank should really try to reduce this kind of mismatches and try to bring in more and more uniformity in the process. Then the retail banking can also be exposed to asset valuation risk. How accurate is the valuation of a particular asset, liability, collateral? What is the kind of valuation model or a mechanism that has been used to value the asset or the liability? How are the hedges really valued? Right? Probably in case of mortgages, how is the prepayment risk typically estimated and figured into the valuation process? Or how can the residual value of the automobiles, if I am trying to look at leasing in case of automobiles, how do I really estimate the residual value of a particular automobile? All these things are the additional risks that can come out, which need to be handled by the retail banking business. Fraud, employees, process, systems, all these kinds of frauds are very much possible. So there needs to be some kind of a mechanism like a fraud detection system that should typically be employed. Then there could be business volume related risks. I have to generate a minimum of this much volume. Strategic risks taken by the management. Mergers and acquisitions, all these are the different kinds of risks that are very much possible. And finally, there could be a reputation risk also, something that is being promised by the bank that is not yet delivered. All these things constitute the other gamut of risks that could be faced by the retail banking firm. Now comes the important part of this session, which is the credit scoring. For all these retail credits, where there are large number of loans, small volume ones, and more homogeneous in nature, rather than applying a manual procedure to typically evaluate each and every loan and processing it, it is much better to have a statistical procedure. Based on the information that I am getting about a credit applicant, or based on the information I get from an existing account holder, a simple score has to be computed for that particular customer. A typical statistical process, I can use a mechanism like a logistic regression or probably a linear regression, which will compute the typical score of a customer, right? So it's an indication of what is the credit risk that is associated with the individual, which in turn means what is the probability of the repayment. So higher is the credit score, I can say that his probability of default is much lesser, the probability of repayment is much higher. Now this way the bank can directly do a filtration of the most risky customers, and it can even reject the applications of the risky customers, or to some moderately risky customers it can even do a kind of a high interest rate. The pricing can be different for some kind of high risky customers, whereas in some cases it can very well reject the applications as well. So to a large extent automation is possible, right? Even for small credits, credit cards, for all these kinds of businesses, this much of automation is quite comfortably possible, because it's very difficult for a human being to really go through all those applications, treat the credit decisions in the same way across all the customers. So because it's a more or less routine kind of a process, it should better be automated rather than a human being involved in terms of the decision making activity. So there has to be a continuous learning that is done by the system, and so the information should come consistently from some external parties regarding the other loans the person is carrying, the kind of default the person is having on the other loans from other sources, and look at whether an attribute is positive or negative and by how much. Again, the weights come through the statistical mechanisms itself, so which will typically give me the odds of repayment based on the past performance. So I can use mechanisms like linear regression, logistic regression, we can use classification trees, neural networks, mathematical programming. There are hundreds of mathematical and statistical mechanisms which can be used to do this kind of prediction. Any of those sophisticated models can very well be evaluated and implemented, and finally understanding of the credit score can very well be done. Now, we also see that one of the most popular credit scoring models that is available in the United States is the credit bureau scores, which are also called as FICO scores. They are very generic kind of scoring models. They don't cost much. Their values range from 300 to 850. 660 and above is like a safer customer, and much below, closer to 300, they belong into the risky categories. So here these kind of scores are more from a broader perspective. Applicants' overall credit worthiness is what is being looked at, but otherwise there could be some kind of pooled models. So these are the three different kinds of models I can see. One is a very generic models called FICO scores. One could be a pooled models, which are typically built by outside vendors. But here the thing is, they collect the data from different kinds of lenders, all the banks. So different banks, different non-banking lending institutions. So the data is collected from all these parties. The data is grouped into more and more similar portfolios, and based on that the model is built. Right? So this has nothing to do with the data from each and every lender. This is in general the overall credit worthiness of the person. So because it is more and more specific to the lending and the borrowing process, the cost is slightly higher than the generic. It can be tailored to each industry separately, but again they can't be company specific because I have to collect the data from different players of the industry. And the third set of model, one of the expensive models but more tailored to the needs of the specific application profile for a specific lender. So it is more and more like developed in-house, it's not a third-party product. And if implemented properly, it can give a very good competitive edge to the bank in terms of really assessing the credit worthiness of the customers and probably doing a much better pricing of the loans to each and every customer more and more in a customized and a tailored manner. So these are the three different types of credit scoring models that you can see. More generic being the credit bureau scores, which are the FICO scores, and the more and more tailored and customized go in the form of custom model. So when I'm looking at the very generic models, the way they collect the information is they collect the identity related information, the personal information, the very basic demographic stuff, generally not used for scoring, but this can change again at a jurisdiction level. So they collect the public from the public records, especially the legal stuff coming from the civil courts, anything to do with the bankruptcy for the person, judgments that are pending or taken against that particular person, any issues with that particular person in terms of his taxes. Then the information is collected with respect to the collection. So the different debt collecting agencies, what is their opinion about the collections from this particular person, and even some lenders also give information. Then we look at the account info, monthly receivables data, credit grantors sent to the credit bureaus. So there will be assessing how regular is this person in terms of making the payments, and in some cases different kinds of inquiries can give different information. Credit grantors only see the inquiries that are placed for the extension of the new credit. So the final risk score that is being computed by FICO is based on the kind of documentation, the transaction type, right? How much documentation is typically required? What is the transaction type? Then the loan to value ratio, debt to income, what is the kind of occupation, the proportion, the payment mechanism, the economic cycle, which is the current business cycle, all these are taken into consideration to typically provide the risk score. Then, whatever is the way, whether it is generic or more customized or whatever it is, once a credit score is computed, there should be a mechanism to really understand the default rates and the loss rates from that. Now this is where there will be some kind of a cutoff score. So that cutoff score will really segregate the good from the bad. So they will decide anything, the score above a particular number, the loans will be accepted, and if the values are below a particular number, they would be rejected. It's a very important decision that will really impact the profitability of the bank and the risk that it is typically taking. And the bank can really determine the loss rate and the profitability for each of the products. And the cutoff score can very well be adjusted. The more and more we keep learning, we can adjust the cutoff score, and based on that the profit margins can also be optimized. Various other things that need to be looked at here: the underwriting, the loan structures, economic capital allocation, pricing, and various other terms should be similar for each group. I have to really take those records which are similar in all these aspects for coming out with a cutoff score below which I take a decision of rejecting the loan. And what the Basel says in this regard, for their different retail loan portfolios, break them into homogeneous sub-portfolios. So they should have similar loss characteristics. Each sub-portfolio should have a very similar loss characteristic. For each of them, estimate the probability of default and loss given default. And use the historical data to compute these things, and based on that come out with a cutoff score for each group to really say for this group, the score below this will not be eligible for a loan. Score between this and this will be eligible for a loan but for a higher interest rate. Scores above this will be eligible for a loan at a normal interest rate. Now, we have typically computed the scores. We have really segregated the good from the bad. Now, this is where I really want to assess the performance of the scorecard. So, the major goal is minimizing the overlapping area. Good and bad, they should not overlap. There should be a clear segregation mechanism between the good risk versus the bad risk. So that is the major objective when I am doing a perform measurement. So there are different techniques. CAP is one very effectively used technique, cumulative accuracy profile, or I can look at accuracy ratio. What do I do here? I take the scores, right? Let's say for 100 customers, I have found out the credit scores. All right. So I sort the scores from the highest rank to the lowest rank. That is what I take on the x-axis. So I give a rank, I sort them from the highest to the lowest and take them on the x-axis. On the y-axis, I take the actual defaults in the percentage term. So here it is the credit scores that I take. Here it is the actual defaults that I take. Now, what is it like if I look at here, right? So the credit score is the top 10 score. So which is the 10th rank in terms of highest to the lowest. So this is my credit score here. I really want to see what percentage typically default here. Now if I take this as the credit score, I really want to see what percentage of the people have actually defaulted from this score to this score. If I take this as the credit score, what percentage of people have actually defaulted between this score? So I am trying to create points of different stuff, finding out for each what is the typical profile of the people who have defaulted. And all this I am plotting a curve. And this particular curve is what I am calling as my cumulative accuracy profile. Now, if you look at it, if I had drawn a line like this, a 45-degree line, then, okay, my top 10 here also the value will be 10%. So, which means there is no effectiveness of the model at all. The model is very, very random. But if my model is going very, very straight up, then it is looking like more and more like a perfect model, right? If I am saying the deterioration is very, very narrow. So if you are saying, okay, 10% high risky guys, the probability of default is perfectly 10%. The actual number of customers who have defaulted is actually 10%. Now that is like a perfect model for me. But what might happen is it might not be very much closer to perfect. Now this is where I am saying if my line would have been like this, where I say my high risk 10% credit scores, the 100% probability of default, 100% of those who had the high credit scores, the 10% is completely, the whole 100% of the people in that particular list have actually defaulted. Now that's like a perfect model. And if it goes something like this, there is an equal chance of good or a bad, which means the 45-degree line is like a random. There is no accuracy to my model. And the more and more my curve is closer to this perfect line, the accuracy is improving. So the bank really wants its scoring model results to be very close to the perfect model line. And that is where it uses a ratio called accuracy ratio, where it looks at the area that is under the perfect model and divided by the area under the actual rating model. This is the perfect model. This is the actual rating model. The closer is the ratio to 1. This area is the ratio is closer and closer to the 1. Right? Because under the perfect model, the area is more like this. Whereas the more and more closer the ratio is 1, the more accurate the model is. So you can very well monitor the model periodically, and probably if the deterioration in the performance is much wider, the model can very well be replaced. And you can also have, if the population is changing, you can change the model. Nature of products changing, you can very well change the model. But this is what the cumulative accuracy profile is one important tool which can really help us in assessing the goodness of our model in terms of understanding the credit risks of the customers. And we also need to understand a slightly different dimension. Right? How does this scoring models typically help in enhancing the customer value? So we are doing a periodic behavioral scoring where the bank is using some kind of information relating to the behavior of the customer. How is he using the credit line? Is he overusing it? Is he not at all using it? Look at the social information of the customer, demographic information of the customer. All these are typically used to determine the default risk of a customer in a particular period of time. So we are looking always in terms of two things. One, the credit worthiness of the customer versus profitability. Right? Probably the customer may not be credit worthy, may be much less or more credit risky. But instead of rejecting him altogether, I really need to assess, if I charge higher interest rate from him, would it be fine? Now, which means the decision that I am taking is a kind of a trade-off. I could have directly rejected the customer, but I'm not, because I am in search of slightly higher profitability. So for every bank, this is the kind of a trade-off that they always get into. So we are looking at product profit scoring, wherein product specific profits made by the lender. Similarly, customer profit scoring is also looked at profitability of one single customer to the lender. And based on this, the lenders can typically make their strategies. Even the credit limits, the interest margins, so they can really make an assessment based on a proper understanding of the product profit scoring as well as the customer profit scoring, which will lead them into going for a risk-based pricing. So where the individual customers with different risk profiles would be charged differently for the same product. But of course, that can very well lead to adverse selection. So because they are typically, if they are paying the different amounts for the same product, majority of the customers whom they would be getting is high risk customers itself. Because that will be very attractive. The product will be very attractive for the high risk customers, but it can be a big disadvantage to the low risk customers. So the bank will end up with more and more high risky customers compared to the low risky ones. The other important point that we have to look at in this context is the customer relationship cycle, where we look at the various marketing initiatives, right? Targeting the prospect and existing customer, tailoring the product to the needs of the customer. Should we mail or should we not mail to the customer? If at all we are mailing, how frequently are we mailing? So maintaining the customer relationship and doing a cross-selling of the different products to the customer is based on one, the marketing initiatives. So you have to understand the different marketing studies that have come out and take your actions and decisions accordingly. And once you have got your applications from the customers, how do you screen them? Which applications to accept and which ones to reject? How much should be the credit line that is extended to each customer? What is the kind of a pricing to do for each of the different groups of customers? So screening of the applications become another important point. And finally comes the account management. So we are looking at the past behavior of the customer, the past activities, and based on that we have to take some kind of decision. Should we authorize? Should we reissue in case something is lapsed? Do I need to modify a credit line? Change the pricing? What should be the level of customer service? What should be the kind of price that needs to be set? So all these come under the cross-selling initiatives, and that's the whole thing that comes under the customer relationship cycle. And one thing we have to understand is all these credit scores are very well linked with the economic life cycles also, which the models need to take into consideration. The business decisions can be made more and more forward looking if they are taking into considerations on how the economy is going to move in the future. And that is where the risk-based pricing strategy comes up, which has been very, very popular in the world of financial services today, wherein you are looking at, they take the inputs from the competition as well as from the regulatory trend. So, completely risk-driven model. Interest rate that is charged is purely risk-adjusted interest rate, wherein they look at the operating expenses, the probability of default, the probability of a particular party accepting that particular loan offer, the loss given default, exposure at default, all these things are typically considered while determining what should be the kind of interest rate that needs to be charged from a particular customer. Even apart from the short-term phenomenon, the long-term factors also can very well be looked at. And this is what will form the basis for setting the cutoff scores, and based on that, the score would be determined and the appropriate action will be taken. So it will help the bank to map its alternative pricing strategies with the corporate metrics. And thus it can really play an important role in increasing the shareholders' value, because it is meeting the management objectives where the risk management is taken while considering multiple constraints that are there. So this can really lead to some kind of mathematical programming models. Different kinds of algorithms can very well be targeted in this regard. And finally, a performance examination where the bad accounts as a percentage of the overall population acceptance rate. That is a kind of a measure of effectiveness of the model, and if required, the model can very well be corrected and redeployed. Now that's what I have here as a part of this chapter. If you have any further queries, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.